Okay, let's kick off the dry bulk panel. So, my name is Lars Oestereng, and I'm covering shipping equities at Arctic Securities. For the dry bulk panel, we have a very exciting lineup today. The owners represented at the panel, they own a total of 230 vessels with a total capacity of about 22 million deadweight. So that's about 2% of the total market, which is quite a lot actually. And I think I'll actually introduce the panelists based on deadweight in ascending order. So weighing in at 1.9 million deadweight, we have the Ultra and Supramax owner and operator, Belships, represented by Mr. Lars Skarsgaard.
Thank you.
And then secondly, Cape-size pure play, Seanergy, Maritime, with 3 million or about 3 million deadweight, Mr. Stamatis, Tsantanis. Okay, close call here, 3.1 million deadweight, EGLE bulk shipping, Supra and Ultra again, Mr. Gary Vogel, CEO. And then finally the giant, 14 million deadweight ton, Supra, all the way up to Newcastle Maxes, Star Bulk Carriers, Co-CFO, Mr. Simos, Spyrou. So, clearly, the dry bulk market has been somewhat of a roller coaster over the past couple of years. Clearly, markets crashed going into the pandemic, but quickly surged. So, we all remember that Cape-size vessels were making close to $90,000 per day last fall. Asset values on five-year-old vessels surged by 70% to peak. 2022 was also off to a pretty good start, but since then we've had recession fears in China clouding the outlook. So, at the same time, as has been mentioned several times today, the supply side dynamics have probably never looked better, or at least in many decades. So I think that with that backdrop, the timing of this panel is pretty interesting. And clearly the big question is, where do we go from here? I think also it's useful to take one step back, and maybe if we go to one of our Supra and Ultramax owners, Gary, 2020 and 2021, what were the main drivers of the dry bulk market in your view?
Yeah, so going back 2020, the market started off, we started with a lot of optimism. We were coming into IMO 2020 with a scrubber-fitted fleet, and of course we didn't expect COVID, and really it was the global lockdown that sent our market south. By the end of 2020, we saw a reopening and restocking trade. We actually went out and bought 9 vessels between November and January 2020, 2021. And the market really delivered, partly because we believe we've been in a cyclical recovery since the market bottomed out in 2016. We took a few detours on the way through this recovery, whether it was the Vale Dam collapse, trade war, tariffs on U.S. soybeans, COVID, crude prices going negative. I could go on, I won't. But through that, supply moderated, and we had a nice build on a relative basis in terms of growth. So that's really what happened in the market. And of course, also with the reopening, congestion, and on the smaller mid-sized ships, we benefited from what we call the spillover trade from containers. So while we had a lot of negatives in the years leading up, a bit of a positive perfect storm, all while supply moderated. And as you pointed out, I'm sure we'll talk a little bit more about it, the supply side, notwithstanding what's been a very robust market, the supply side remains muted. If you had asked me at the end of 2020 where we would be, the Supermax index has averaged $25,000 over the last almost 2 years, since January of last year. If you asked me what the supply side response would have been almost 2 years of that kind of number, I don't know what percentage I would have come up with, but it wouldn't have been 7%. So I think it's, for a number of reasons, I think it's a really interesting dynamic that we have had a robust market. And although, talk is like dry bulk is, what happened, the index last year, the Supermax index averaged just under 27,000, and this year it's over 24. So we're enjoying a robust market, and that's a Supermax vessel, not an Ultramax, and non-scrubber fitted. So I'll stop there.
Thank you, Gary. So maybe moving on to one of our Capesize owners, Stamatis. 2022 has been a little bit different than 2021. What has happened?
Well, it's a combination of negative events. First of all, you had all this unwinding of the congestions in China, so that put into the market again about 100 to 150 ships at any given time, so that's a lot of supply hitting back. Then what's most important, in my opinion, is the self-inflicting, lockdowns in China. Don't forget that this is a country that it's getting into its 4th year of lockdowns, and that's very unfortunate for the business. 4 years, 2020, 21, 22, and now we're getting into 23. It's going to be the 4th year of lockdowns in China. So a combination of all these events was more negative as compared to the positive of the coal trade that went up due to the energy requirements of Europe and the rest of the world. So, to sum up the whole thing, I believe that when the market returns into the equilibrium, which is congestion back into play again, slow steaming starting next year, and China getting back on its feet, which we strongly believe is going to happen in the next 6 to 12 months, I think we're going to see a massive recovery on the Capesize rates.
Thank you. So that was a little bit on the outlook, but I want to ask you, Lars, is the future bright? You are representing the company on this panel with the highest fixed rate coverage going into 2023.
Yeah, thank you. So I'm happy to be the bearish one on the panel since we fixed out most of our ships.
Of course.
I think every conference should have a special offer, and maybe that's dry bulk actually, because I think even though the market has corrected over the past couple of months, if you zoom out and look at it historically, it's actually a quite good market, and all of us up here are making a profit right now. So it's not a bad market at all. Whilst equities have corrected down, should we say a third, give or take, in the past 3 months. So while we have a bit balanced and maybe a short-term skepticism to the market, if you look at it from the equity side, it looks more interesting than in a long time. For our part, we started actually late last year and continued this year fixing out most of our ships for 1 and 2 years. Purely from a risk-reward standpoint, we could fix out our ships at more than double our cash break-even to good counterparts, and then rather grow with more modern ships. So for us, that in sum seemed like a prudent bet. And right now we're fixed out with basically a bit more than 80% plus for the next year. So we don't really have a big market exposure before the end of next year and beginning 2024. So long term, more bullish. I think I've seen a quote earlier from Dr. Stopford at the time where people tend to over-exaggerate short-term developments in shipping and underestimate the long-term. And we try to keep that in mind. We're fixing out our ships short-term and then trying to position ourselves towards the longer term with green shift and decarbonization.
Very well. So Simos, what about you? You are mostly open going into 2023, right?
Thank you, Lars. Indeed, I think I represent here the bull of this table. We are traditionally a spot operator. The entire part of our bigger vessels, the Capes and Newcastlemaxes, are in the CCL pool, which is a pool that we have together with Bocimar and CTM of Monaco. All these vessels are spot. And the medium and smaller size Kamsarmaxes, Panamaxes, Supras, Ultras are usually we have a strategy where we try during the fourth quarter of the year to get some exposure to cover part of the fleet for Q1 and Q2, which is traditionally the weaker part of the year. This year it seems that the forward curve is already pricing quite weak, let's say, first half. So we have not been quite active in hedging the first 2 quarters of the year. If we see some, a spike there, we might do some more. But right now we are, I would say, spot. The reason behind that is that we remain optimistic on the dry bulk fundamentals for the medium and the longer term. We believe that the next 2 quarters, 3 quarters might be a bit challenging, but medium to long term, all the fundamentals show that the market is going to be quite positive, both from the supply side. We are seeing, a record low order book to the tune of 2%. We believe that all the new regulations that are kicking in from 2023 onwards are going to increase, are going to reduce the speed of the vessels and effectively reduce the overall supply. We believe that we're going to see increase of hires from vessels that eventually will need to do some retrofitting to be able to comply in 2023 and 2024. So supply side is phenomenal, good. And on the demand side, we expect that the recovery both of the Chinese economy with the gradual reopening after the lockdowns will be assisting. Plus, on top of this, we have 95–97% of our fleet, which is scrubber fitted, which right now with the spread between HSFO and VLSFO at $300 produces an annual benefit for our fleet to the tune of $210 million. But even with 200, which is the forward curve for 2023, it's a figure of around $140 million. So this is a downside protection as we see it, and a reason for us to remain spot.
Thank you. Simos and Stamatis, you both mentioned China, of course, and as Capesize owners and operators. What is really going on in China? I mean, the property market still looks quite horrible. Steel production continues to slide. Iron ore imports clearly down year-over-year. So what can we really expect going into 2023 with regards to China? Clearly they have this Communist Party Congress this week. Have we gotten any positive news flow out of that?
Well, thank you.
Take the word.
Thanks. So, yes, obviously there are some positive and negative news from the conference. The negative news are that they will remain their COVID-0 policy, which unfortunately means that they will keep people in lockdowns with just a few cases here and there, so that's quite unfortunate. At the same time, though, and what's very positive about the speech, the 2.5 hour speech, is the fact that they will have much strong energy independence as regards to crude oil, which is not of our concern of this panel, but mostly coal. So we expect coal imports, infrastructure, and all these other elements that are very associated with the Capesize sector to be very strong in the next few months, because China needs to come out of this again, like I said before, self-inflicted lockdowns and crisis, and they will need to lead growth back to what it's expected from their political parties. So we believe that infrastructure work is going to resume. We see that. We see the iron ore inventories at the ports to deplete, so they need to do some restocking. And we expect infrastructure to be quite strong in China. So yes, we've had a lot of negative news in regards of iron ore imports and steel production, but we expect that to be reversed soon.
Just if you allow me to add, a couple of figures here, I fully agree with Stamatis. China accounts for approximately 50 to 55% of the global steel production. Last year, year on year, their steel production was down 10%. This accounts for approximately 4% reduction in the global dry bulk trade in terms of steel. If you take into account the fact that 2/3, approximately, of the global iron ore trade is going to China, and 90% of this is transported with Capes, Newcastlemaxes, and VLOCs, the level of the charter rates that we currently see in the Capes and Newcastlemaxes is quite healthy. If someone would have told me, 2 or 3 years ago, that we would see a 10% reduction in the Chinese steel production and the Capes are going to be where we are seeing today, I wouldn't believe him.
A very good point. So China might be coming out of their little crisis, but clearly the rest of the world also seems to go into a recession. China may be coming out, the rest of the world going in. Lars Christian and Gary. So how will that impact the market? China on the one hand, and then the rest of the world on the other hand, moving in the wrong direction.
Should I start?
Go ahead.
Well, starting about China, I think if we zoom out, the big boom in the early 2000s was started by China's phenomenal growth. And at the time, were they the world's 15th, 16th, 17th biggest economy? And they had a phenomenal growth per year. They are now the world's second biggest economy, and it's a question of time before they overtake and become number one. So I think the fact that their growth is slowing down is inevitable as they rise up to the tiers of the bigger economies. And even this year or next year, if they have growth of 3 to 5%, it would be a growth I think a lot of Western economies would be enviable about. I think dry bulk in a way is split in two, and this side of the panel with Gary and myself, we represent what I call the GDP carrier of the dry bulk market. The dry bulk market is driven by the demand for food, energy and infrastructure, and the Super Ultramax class is the world's biggest ship with cranes, and that's our part of the market. Capesizes is basically a play on iron ore and Chinese steel production. A bigger weight of Chinese demand and steel production than in our markets. And that's one of the reasons why we have more downside protection. And if you see the last year, the last 3 years, the last 10 years, a Supermax and Ultramax has fared better than any other size in the dry bulk market. So to your question with when is China coming back, what about the rest of the world? One thing is for sure is that if you look at the average earnings against the cost of the vessel, last 10 years, again last 3 years, and right now, Ultramax is the safest place to be, the widest diverse cargo base, and much less prone to demand shocks.
Yeah, I'll just add, it won't surprise you, I agree with those comments. It's also the diversification of the cargoes we carry and also the geographies in which they're carried to. So we spend a lot less time in ballast, more triangulation. And again, when a certain trade goes away, it's not so dominant that we don't pick up another one. In fact, the largest trade that we do is only 14% of our total. So, and we get 2/3 of our demand from minor bulks. And minor bulk demand was greater than major bulk, which is coal, iron ore, and grain, over the last few years, last year, this year it's positive. Dry bulk, major bulk is negative this year on a non-ton mile basis, and it's expected to lead dry bulk demand next year. So it's not just a one-off. As Lars Christian said, if you go back, in fact, if you look in our investor material, we put a finer point on it. If you bought a Ultramax, 5-year-old Ultramax in January of 21, or you bought a 5-year-old Cape in January, the return is 46% on the Ultramax, assuming you just put it out at index versus 25. So it's pretty meaningful, delta. I want all dry bulk to do well, but the safer place, because of that diversification, is in the mid-size. No question, GDP, dry bulk's inextricably linked, especially, the minor bulks, and so I think, a more, cautious approach over the next 6+ months is warranted. Having said that, the supply side, this year, the mid-size segment, what we call Handymax, which started as, 40,000 deadweight and then went to Super and Ultra, but that mid-size segment, just to, put some context, there's just under 4,000 mid-size, what we call Handymax vessels in the world. Through September 30th this year, there were 2 ships that were scrapped. And in fact, over the last 5 years, there's been incredibly limited amount of scrapping, notwithstanding scrap at record prices. And that's a really positive thing as you go in with limited supply coming, because if we find ourselves in a period of muted demand and rates come down, clearly these older ships that have been hanging on, and why wouldn't you? If the market is 18, even if that ship only earns 14, without financing, you're making close to $10,000 a day. And so, but if we find ourselves in a more muted, rate environment, there's a lot of scrap candidates that should have been scrapped over the last few years, and that's going to happen in the next number of years. Ships need to dry dock every 5 years, up to 15 years old, but then every 2.5 years, which means 40% of the fleet that's over 15 years old needs to dry dock every year. That's a pretty big decision, which is really driven by spot rates. No owner wants to be the guy that missed the next upturn in the market, right? And I always say you can't unscrap a ship. So a lot of guys will go past, India Bank.
Recycle it.
Yeah, or you can't unrecycle a ship, let me put it that way, right? So a lot of people will hang on because they don't want, but eventually as these ships, in a weaker rate environment, we're going to see scrapping increase, which is going to come at the same time as supply, limited supply comes into the market over the next few years.
Thank you. And Simos, since you're the only owner owning vessels all the way from Supras up to Nukes, and only short answer here, which size segment do you or Starbulk hold the highest hopes for going into 2023? One word answer.
No pressure.
Challenging. No, I believe on Capes on the bigger asset sizes. I believe on the recovery story of Capes, Newcastlemaxes.
And clearly, they tend to correlate. Okay, so it's been mentioned several times already on this panel. Environmental regulations. So EXI is coming up, CII is coming up, and you said, okay, we might see vessels steaming slower, more time to fix things to get into compliance and so on. I think last time this industry was facing similar regulations, Starbulk was kind of a pioneer on scrubbers, and clearly EGLE also. But what are you making of this EXI and CII regulations? Will they be as impactful as everyone's saying these days?
Well, I won't get into detail on EXI and CII. We've heard, I believe, in each single panel today about the two indices and how many vessels comply, how many they do not, if CII is as an algorithm okay or needs amendments. You've heard from all the previous panels. What I would say is that as StarBulk, we're focusing, the new environmental regulations are on top of our agenda. Right now, we're focusing a lot on major investments, ranging from carbon capturing to energy-saving devices to hull cleaning robots to advanced anti-fouling paintings. So we are involved in a number of initiatives, both on an R&D level and right now on some of these initiatives on testing these technologies on board of our vessels, and which we believe that going forward are going to reduce our carbon emissions and will improve the profile of the fleet. The 2 points that I wanted to raise here, and for people to understand, is that we believe we estimate that approximately 60% of the fleet today are non-eco vessels. About 40% of these non-eco vessels are built between 2009 and 2013 in second and third year Chinese shipyards that today probably do not exist anymore. And these vessels are fuel thirsty and are going to be almost impossible to comply with the new regulations. So it's going to be inevitable that, and adding, to what Gary was telling previously, that we're going to see an increased number of these vessels in 2024, because 2023 primarily is the year that we start measuring, as owners, our carbon footprint. From 2024 onwards, these vessels are not going to be able to comply. So either they will need to do huge investments and reduce speed significantly, and I do not know what else they need to do, or we're going to see increased scrapping activity, which will add to the, the great supply curve that we have right now. And this is what keeps us, optimistic for, the longer term in our market.
Thank you. And this is a question for all of you. So, in light of all of these new regulations, for how long would you be comfortable owning a 10-year-old vessel? So we're starting with Lars Christian and then moving up to Simos at the end.
Okay, thank you. Well, first of all, maybe a point of disagreement. I think actually nothing will happen next year, unfortunately, with these 2023 rules. You correctly mentioned that next year is the first year of starting to measure it. But anyone thinking that the supply side is going to fall magically by 10 or 20% on speed on 1st of January, it ain't going to happen. It didn't happen in IMO 2020 either. The only thing which happened was that prices changed for fuels, but there was no problem with supply. And EEXI next year is as mentioned, it's going to be a 12-month process. And then again, people tend to exaggerate short-term changes. Longer term, we positioned ourselves towards 2030. And the question, how long can you own today's asset, is a good one and a relevant one. So instead of waiting for the right propulsion system, paying too much to convert for a possible option on a different fuel, instead of approaching it practically, we've done two things. First of all, just buying the most modern fleet possible today, and then financing it in a way where we can actually redeliver and walk away from 75% of our debt and our ships in 2030. So we've basically, maybe it sounds strange, but we've tried to approach ESG and 2030 by doing it financially. So I think we're one of the only, I think we are the only stock listed company who can actually just redeliver most of the fleet by 2030 and then do 180 and do something else.
Yeah, so I mean, this is exactly where we focused our fleet renewal, right around the 2015. In fact, just 3 weeks ago, we bought another 2015 vessel, and we're up to 30, kind of between, almost exclusively 27 of them between kind of 2013 and 2018. And the focus is really because of what I call that tail risk, right? If you order a ship today delivering in 25, that ship's only going to be 10 years old in 2035. It's going to be 40% through its economic life, and based on historics, that ship's going to have to sail all the way up to 2050 when we're likely going to be, shipping will be at zero emission in order to reach the Paris climate target. And we just don't want to own a ship that, because ship values are based on future cash flow, right? And so that's why we think that having ships that'll be 20 years old in 2035 is the place, because in 2030, as much as we believe we'll be in a position to start ordering vessels and getting zero emission ships on the water, it's going to take a long time to ramp up. So I'm not worried about owning a conventional ship in 2030. I would be concerned about owning a 5-year-old conventional ship in 2030, not because it can't trade, but because the value when you try and sell it will be severely impacted. So, it's really about strategizing and as the points were made, I fully agree, right? It's about, right now especially, it's about, improving efficiency as much as possible. It's good for the environment and good for the bottom line. And as we transition to zero emission fuels, storage and competing for those fuels with other industries is going to be, it's going to be severe competition. So whatever we can do to reduce the consumption of our vessels, no matter what the fuel is really important, not just for now in the environment, but for those zero emission fuels of the future too.
Well, we took a big bet the last couple of years where we effectively doubled our fleet. We spent more than $250 million by buying all these capes that we bought, and we went up to the 3 million tons that we currently own. We strongly believe that the current ships will continue to trade with minor interruptions in the next few years. We have started to invest on energy-saving devices since 2018, and we have improved the carbon footprint of our vessels sometimes up to 15%, which is massive. And that's something we've done in cooperation with our charterers. But even when we did it on our own, we can still re-rate our ships and make them much, much better. Like Simos and Gary said, we have one of the lowest order books in history of shipping, and knowing that there's no new supply coming in to the market, we have to live with the current ships for the foreseeable future. Nobody knows what the propulsion of tomorrow is going to be. So what we do in the meantime is that we install energy-saving devices very extensively. We try to make our ships more economical. We burn a lot of biofuel, and we do whatever we need to make in order to make the ships more economical and tradable for the future. Now, the careful selection of a second-hand value of a second-hand ship is crucial because, like Simon said before, a lot of the second-hand ships being offered up for sale at a large discount, there is a very good explanation for that discount because the ships will not be making it for 2024 or 2025. So we chose ships when we doubled our fleet that we strongly believe will last for at least the next 6, 7, 8 years up until 2030. And by that time, we will know what the solution is going to bring for the shipping industry. We cannot live without tonnage out there. People need to still move stuff, raw materials, minor bulks, major bulks, whatever you want to call it, because the world is dependent on shipping. And with zero order book, to Simo's point before, about 50% of the fleet will be 15 years or older in 2025, and that's basically 2 years from now. So 15 years of age is the cutoff point for a number of charters, especially in Australia, and I want to see how they're going to be able to fulfill their transportation needs, which is more than 1 billion tons a year, without having modern ships out there with the supply being zero. So, thank you.
Simos? A quick answer on that one. We're running out of time.
Yeah, no, I agree with all comments that we've heard from all three co-panelists. The main issue here, and what we are fully agree, all of us, is that there is no new technology yet available for the vessels. We're not ordering vessels, so we are focusing a lot on improving the existing fleet and investing on the reduction of the carbon footprint of the existing fleet.
Very good, thank you. So I was planning to address capital allocation as well, but I think we will do that one very quickly. I have one question for the entire panel, and I want a short answer from each of you. So if you had, and we're starting with Simos this time, and then move this direction. If you have 10 million today, how would you spend it?
10?
And then I guess that...
10 million.
$10 million.
The answer is clear.
You got to call a bank.
No. I would buy, our stock, which is trading, at a significant discount to NAV, by far.
Very good. Stamatis?
Well, the same. Buyback of the stock, as well as investing more in energy-saving devices on board the ships.
Just a few weeks ago, we bought a 2015 built Ultramax at a considerable discount to recently done, so we think there's good value on the medium to long term.
I'd hand it back to you guys and then trust that you come back and buy BELCO shares tomorrow at below NAV.
Very good answer. So, and one final question. So, as I alluded to begin with, since the peak this spring, asset values for 5-year-old vessels are down by around 15%. So the question is, and also once again, a very short answer, starting with Lars, the former S&P broker. In 12 months' time, will values be higher or lower or flat?
Slightly down from today.
12 months higher.
Same here, higher, I believe that.
I'm in the middle. No, I expect that we're going to see a two-tier market. Based on what we've been discussing before, we are going to see a spread widening between vessels that are, those vessels that, are non-eco, very difficult to comply with new regulations, and the more modern eco vessels, which are going to be easier to comply. So the short answer is that the modern eco fuel-efficient vessels are going to be higher from where we are today. I'm not sure about the non-eco, the fuel-thirsty vessels probably are going to be at a lower valuation from where they are today.
Okay, so if I try to sort of assemble the consensus here, it's a surprise, of course, that a panel of dry bulk executives are optimistic on they're optimistic on values, rates, and that's all clearly on a consensus level. But the consensus is clearly that this market is, or the outlook is very good. Okay, with that, I'd like to thank all the panelists and all